So every single time stocks rip to new highs, what's the first word you hear? Bubble, right? And that fear, it's totally real. I mean, we've all seen this movie before, and we know how it can end. But what if this time is actually different? What if this isn't a bubble at all, but the start of something huge? Something analyst Tom Lee calls a multi-asset supercycle. So, which is it? A bubble warning or a supercycle? Let's dig in and deconstruct the argument.
You know, it's so easy to get that feeling of déjà vu, right? You see the headlines, you see the charts just rocketing straight up, and it feels exactly like the late 90s or the mid-2000s, just before the floor fell out. So the big question is, are we just rereading the same old script, or is the ending to the story going to be completely different? Okay, so on one side, you've got the ghosts of market crashes past, right? The dot-com bust, the housing crisis, we remember those vividly. And on the other side, you've got today's high flyers, AI, big tech, all the crypto assets. And look, the patterns do look eerily similar. That's why so many people are screaming crash. But this is where Tom Lee says, hold on. You're looking at the surface. You're missing the really crucial details under the hood.
All right, first up, the AI reality check. And probably the biggest comparison you hear everywhere is that NVIDIA is just the new Cisco, the poster child for that whole dot-com speculative frenzy. But Lee's argument is simple. If you stop listening to the narrative and actually look at the hard numbers, that comparison doesn't just look weak, it completely falls apart.
Okay, let's actually look at the data. This is so important. Back in 1998, Cisco was trading at a whopping 56 times its forward earnings. That's what people thought it would earn in the future. Just a year and a half later, that multiple exploded to an unbelievable 210 times. Now, fast forward to today, look at NVIDIA. It's trading at just 27 times forward earnings. I mean, it's not even in the same zip code, let alone the same ballpark. It's a completely different valuation story. And here's a quote from Lee that really puts a fine point on this. He points out that Costco, the membership club, a fantastic, solid company, but pretty predictable, right? Well, Costco trades at 50 times forward earnings. That's almost double the valuation of NVIDIA, a company that is literally at the heart of the biggest technological shift of our generation. Does that sound like a bubble to you? Not really. But it's not just about the numbers. Lee says that real bubbles, they have a certain smell to them, a kind of manic, crazy energy. He points to stuff like hedge funds literally front-running university research just to get an edge in biotech, or the everyone's a genius attitude during the housing crisis, where people were flipping houses with no money down. That kind of wild, risk-blind frenzy, it's just not here today with AI. Instead, the investment feels much more measured, almost cautious. It's like everyone is constantly looking over their shoulder, waiting for the other shoe to drop.
Okay, so that's the AI piece. Now let's pivot to the second part of this whole supercycle puzzle, gold. Gold has been on an absolute tear, and frankly, its strength has a lot of people scratching their heads. But according to Lee, the new driver of demand isn't what you'd expect, like central banks or jewelers. Nope. He says it's coming from a place nobody was looking, the crypto world.
So check this out. Here's how this new liquidity loop apparently works. When a stablecoin, basically a digital dollar, is created, it needs to be backed by a real asset to keep its one-to-one peg with the dollar. And what are the issuers of these stablecoins buying for collateral? You guessed it. Increasingly, they're buying physical gold. So this creates this totally new, organic, and consistent demand for gold, which naturally pushes its value up. And that rising value for gold, it starts to pull Bitcoin's potential value up right along with it.
Okay, and this is where the numbers get, well, pretty mind-blowing. So following this logic, Lee did a calculation. If this new demand pushes gold's market cap to a certain level, let's say where gold is priced around $5,000 an ounce, and if Bitcoin just achieves a similar network value, well, that would imply a fair value for a single Bitcoin of over $1.6 million.
This completely flips the script. For years, the debate was always gold or Bitcoin, right? They were rivals. But the new reality, according to this thesis, is that they aren't rivals anymore. They're actually becoming partners in liquidity. The growth of tokenized dollars is creating demand for both of them. It's a symbiotic relationship.
All right, so if Bitcoin is the new digital gold, then what in the world is Ethereum? Lee's take is that Ethereum is something entirely different. It's not a store of value, it's the new plumbing. It's the fundamental rails that Wall Street is going to use to rebuild the entire financial system from the ground up.
And to explain this, he uses this really powerful analogy he calls the 1971 moment. That's when the US ditched the gold standard. All of a sudden, the dollar was basically synthetic, and Wall Street had to scramble and build a whole new financial system. futures, CDs, the whole shebang, just to make it work. His point is that we are living through that exact same kind of fundamental rebuild right now. But this time, the foundation isn't being built on skyscrapers on Wall Street. It's being built on public blockchains.
And you can kind of see this progression playing out on this timeline. You had the US leaving the gold standard in '71, then the '80s when Wall Street built out all the modern markets, and now, here we are, and Wall Street is finally starting to tokenize real-world assets. We're talking stocks, bonds, you name it, and put them on public blockchains. And when you look at where this is all happening, there's a clear runaway winner. Something like 70% of all these big money institutional tokenization efforts, we're talking about giants like BlackRock, Robinhood, they're all building on one chain, Ethereum. It's become the default choice, the main settlement layer for what finance is going to look like tomorrow.
So, okay, what does that mean for the price? Well, Lee's target of $21,000 might sound crazy, but it's not based on some wild guess. It's just simple math. It's basically the price Ethereum would reach if it just got back to its old valuation relative to Bitcoin from back in 2021, and this time it would be powered by this massive fundamental adoption by Wall Street.
Okay, this brings us to the last piece of the puzzle, and honestly, it might be the most interesting one, the psychology of this market. Think about it. The market is hitting all-time highs day after day, and yet nobody seems happy about it. Investor sentiment is just terrible. Lee actually calls this the most hated rally in history.
This chart just lays out the great disconnect perfectly. On one hand, you have the S&P 500 up, let's say, 15% for the year, a fantastic return. But on the other hand, average investor sentiment is deep in negative territory. The numbers are objectively good, but the feeling is just plain bad. So what's going on?
And just to be clear, a sentiment reading this negative is not normal. It's incredibly rare. You only see this kind of deep pessimism during the absolute worst of times. Think about the crashes in 1990, 2008, or even 2022. To see this level of fear while the market is in a strong bull run, it's almost unheard of.
So what's Lee's explanation for this? Well, it's pretty controversial. He says this isn't really about economics at all. It's about politics. He points to data suggesting that a big chunk of the professional risk takers, like hedge funds and venture capital, lean Democratic, and they're bearish because of their view on the current political landscape. But then you look at credit managers, who are mostly Republican-leaning, and they're showing absolutely no fear. It's a huge divide. So when you take a step back and you put all four of these pieces together, the picture that emerges is, well, it's very different from this simple bubble narrative. You've got an AI boom that's actually backed by real, solid earnings. You've got crypto creating these new powerful liquidity flows for hard assets. You've got Ethereum becoming the literal infrastructure for the future of finance. So according to Lee's thesis, this isn't just a speculative bubble. It's a massive fundamental evolution. And the craziest part? It's all happening inside a market that is just dripping with disbelief.
And all of that leaves us with one big, final question to think about. In a world that's being reshaped by technology, new forms of money, and deep political divides, is the market's relentless climb a sign that it's completely detached from reality? Or is it a sign that the very definition of financial reality is being rewritten right here, right now?